Hi, everybody. Zach Anderson with Valley Estate and Elder Law here to talk to you today about one of the most important concepts in estate planning and elder law, and that is the step up in basis. This is something that needs to be looked at for every estate plan, whether we're trying to get a step up in basis or whether we're trying to not get a step up in basis. That's going to depend on a number of factors. Most Americans are probably going to want to achieve this. However, not everyone. Nonetheless, we want to look at it. It's really, really powerful. It's a tax concept, and we're going to dive in with an example in just a second. But here's what it is. It's a tax concept that says when you sell property that you own, you are taxed. You get taxable gain on the fair market value, what you sell it for roughly, minus the basis. The basis is what you start with. And I'll explain that more in just a second, but that's the way I like to think about it. Fair market value minus basis gives you taxable gain. Now, this is an oversimplification, and this, of course, is not narrowly tailored legal advice to your situation. We haven't met yet. However, this is generally how I like to think about it. So let's see an example. Let's say mom deeds you a house. And mom, a long time ago, when she bought the property, she paid $100,000 for it. She deeds you the house. She passes away. You're the sole owner. You get to sell the property. Let's say you want to sell the property for $500,000. It's appreciated a long time since mom bought it in, 2004 or 2015 or whatever it was. You sell it for $500,000. You don't want to live in the property. Maybe it's across the country. Maybe you need to sell the property, get money for a child's medical care or going to college or something like that. So you sell it. It's your house. You can do with it what you please. You sell it for $500,000. Basis is what we start with. That's $100,000. You get a taxable gain of $400,000. That's really significant because your long-term capital gains tax rate might be as high as 24% or much more likely 20%. But let's just say it's 24% if you're in the highest tax bracket, and it could be 24 depending on how long you owned it. But nonetheless, let's just use the 24 number. That's $100,000 going to the IRS. That's really significant. That takes me a long time to make that money. I mean, I don't have that lying around. I don't think I need to tell you that that's a lot of money. That's something that is without a step up in basis. Let's look at what happens when we get a basis step up. Let's say mom keeps her house for her entire life. She writes a will or a trust that says you get the house once she's deceased. When you inherit property, you usually get a step up in basis. So let's look at this math. You sell the property, same example as before. You sell it for $500,000. That's the fair market value. Now, what is our basis to determine our taxable gain? Well, when we inherit property, if everything is done properly, we get a step up in basis. Mom's original 100K in basis goes up to 500K. It gets stepped up. That's the step up in basis. So what's our taxable gain? 500K minus 500K, $0. That is how powerful the step up in basis is. I want to be clear that this is a conceptual example, and this doesn't factor in realtor fees or the amount of appreciation between the time you sell it and the time you inherit it, which if you wait a long time to sell it could be significant. Also, these numbers are just going to depend on your situation, most certainly, but this is the power, the impact, the magic, whatever you want to call it, of the step up in basis. Whatever we do, even if it's a will, power of attorney, I mean, anything, we have got to make sure it squares with what we want to do, especially with regard to taxes. And the step up in basis is the biggest thing we're worried about in taxes in general. Now, you know how it works.